Let me ask you a question. If I told you that investing just Rs 500 a month starting today could be worth more than someone investing Rs 5,000 a month starting 10 years from now, would you believe me? Most people don't. They think investing is something they'll do later, when they have more money, when the market is better, when life settles down. But later might be the most expensive decision you ever make. Here's the real math. Let's say you're 25 years old, and you invest Rs 500 every month for the next 40 years into a diversified index fund. The average stock market return over the long term is around 12% annually. At 60, your investment would grow to approximately Rs 1 crore. Now, let's say you wait. You're 30, finally ready, and you invest Rs 5,000 a month, 10 times as much, for the next 30 years at the same 12% return. You'd have roughly Rs 1.05 crore. You invested 6 times more money and ended up with less. That's not a coincidence. That's compound interest punishing procrastination. Compound interest is money earning money, which then earns more money. Albert Einstein called it the eighth wonder of the world. But most people misunderstand it because they underestimate how powerful time actually is. When you're 20, you have time as your biggest asset. Even if the market crashes, you have 40 years to recover. When you're 30, each crash hits harder because recovery time is shorter. Time isn't just helpful, it's everything. Now, you might be thinking, I don't have Rs 500 a month. Fair point. But that's exactly why you need to start now. SIP investing, Systematic Investment Plan, is designed for people like you. You can start with Rs or even less per month through most apps. The amount matters less than the consistency and the starting point. I know people who started with Rs 100 monthly at 23 and are worth over Rs 50 lakhs by 40. Not because they were rich, because they started early and stayed disciplined. So how do you actually start? First, open a Debunked account. It takes 10 minutes online. Second, choose an index fund, not individual stocks. A beginner's stock market basics mistake is picking random companies. Index funds take the guesswork out and give you exposure to the entire market. Third, set up an automatic SIP for even Rs 500 or Rs 1000 monthly. Then forget about it. Don't check daily. The people who get rich from investing are the ones who set it and don't panic sell when the market drops. The hardest part isn't the math or the strategy. It's starting. Our brains are wired to procrastinate on long-term decisions. We think, I'll start next month, and next month turns into next year, and next year becomes a regret that costs you crores. This is a personal finance fundamental. Your 20-year-old self cannot gift your 40-year-old self anything more valuable than time in the market. Here's your action plan. Step 1. This week, open a Debunked account. Step 2. Choose one index fund. Nifty 50 or Sensex are solid choices. Step 3. Set up an automatic monthly SIP for whatever amount you can afford, even if it's Rs 100. That's it. You've now done something 90% of people never do. You've started. The time value of money isn't complicated. A rupee today is worth more than a rupee tomorrow because today's rupee has time to grow. You can't get back the years you didn't invest. You can only move forward. So start now, stay consistent, and let compound interest do what it does best. If this clicked for you, like this video, subscribe for more investing tips for beginners, and drop a comment with your biggest money regret. Let's learn from each other.